In this video, we're going to take a quick look at Forex correlations. Now, Forex correlations can be an incredibly useful tool for traders, and so it's important to get a good understanding of what they are and exactly how to use them. So simply, a correlation is a measure of the strength of the relationship between two variables, and in the case of Forex trading, we're looking at the strength of the relationship between two currency pairs. So you can see on the chart here that we have sterling yen and sterling CAD shown over the last 30 days. And as you can see, they've both moved pretty much in tandem the whole time, selling off into the first part of December and then trading up since then. So it's quite clear looking at these two currency pairs that they share a fairly strong positive correlation moving together. Now, correlations are given a numerical score between -100 and +100, where +100 means that the two share a strong positive correlation, both moving in the same direction, and -100 means that the two share a strong negative correlation, both moving in opposite directions. Now, to keep an eye on correlations between currency pairs, we have two choices. You can simply look to overlay charts and it will be fairly obvious to spot the pairs that share strong positive and strong negative correlations. But for a more specific approach, you can use a Forex Correlations dashboard. There are lots of good ones online, but the one that I like to use and that we'll take a look at here is the MyFXbook Forex Correlations dashboard. So you can see here that this dashboard displays the correlations between all the various currency pairs. The key thing to remember here is that any number over +70 indicates a strong positive correlation. Obviously, the closer to 100 the better, and any number below -70 indicates a strong negative relationship. So these are the categories that you want to focus on, and the MyFXbook dashboard actually lets you filter for these, so you can look to find currencies with correlations lower than -70 and find currencies with correlations higher than 70. So that will then highlight with these red and green bands the currency pairs which share these strong correlations. So any scores that aren't in these bands, any scores that are closer to zero, such as +30, -40, etc., these indicate a fairly weak correlation, and so these are only really useful if you're trying to put on a group of trades which aren't correlated. Now, the other thing to bear in mind is that the correlations for the currency pairs are different over different time frames. And so a pair which has a strong correlation over the last 24 hours may not be correlated at all over the last month. So it's important when using correlations to consider the time frame that you're trading and your trading horizons. It's obviously no good to use a daily correlation to take a weekly setup. The other thing is that the correlations themselves also change constantly. They aren't fixed, and so it's important to stay abreast of these correlations if you use them in your trading. Now, obviously, we can select the time frame here, and if we take a look, for example, at the correlation between sterling yen and Aussie CAD, which at the moment is strongly negatively correlated, meaning that they're moving in opposite directions over the last month. Now, if we pull that down to 4 hours, we can see that it goes up to being strongly positively correlated, 81%, meaning that they're moving in the same direction. So that's a good example of how the correlations are different over different time frames. The other great tool here is that the MyFXbook Forex Correlations dashboard allows you to view the historical correlations, so you can view the way that the correlations have changed over time. So if we click on the sterling yen Aussie CAD correlation, for example, so we can see here just exactly how the correlations have shifted. So we started out being strongly negatively correlated, moving all the way up to being strongly positively correlated. So that's a really useful tool and one to keep an eye on when you're using correlations. So let's talk about using correlations then in our trading. So first of all, one of the clearest ways to use correlations is that We can use strong correlations to extract more profit from the market on a particular move. So where we identify a really solid setup in a pair, or identify a strong directional bias, a clear trend, we can then look to pairs that share a strong correlation with that pair to also play the move. So looking at the sterling CAD and sterling yen, for example, we can see that they were both trading down into the final weeks of August, and we can put in these pretty rough bearish trend lines here just to highlight the downward trajectory. We can see that as the sterling CAD broke out through its bearish trend line in the first week of September, we can note that the sterling yen then followed suit and broke out of its bearish trend line too. So we can see here that we're effectively playing a GBP strengthening. Now, identifying these strong correlations allows us to perhaps take both trades and spread our risk over the two. So we can use correlations in this manner to confirm a move. So where we have strong correlations in play, we would look to see similar setups emerging. Now, if we had seen sterling CAD breaking out of its bearish trend line, but the sterling yen not breaking out of its bearish trend line, then that would question the validity of the move and suggest that maybe it's a false breakout. So that's one way that we can look to use correlations in Forex markets, is look to capitalize on moves in a specific pair by trading also in pairs that are strongly correlated. However, another really important way to use correlations as traders that actually stems from this point is that we always want to be managing our risk and managing our portfolio risk, and this is where correlations can be really useful because they can help us to ensure that we don't become overexposed. So whilst we're probably fine here to trade two strongly positively correlated pairs, so long as our risk is managed, we wouldn't want to be trading 5 strongly positively correlated pairs, as all we're really doing is loading up our risk on one particular move and opening ourselves up to unnecessary losses, especially in the face of an upcoming risk event, for example. So again, it's clear here that the driver of the correlations between these two pairs is primarily the GBP relationship. However, correlations between pairs aren't just based on the pairs sharing a base currency, and there are all sorts of drivers affecting correlations, such as relationship with the US dollar, relationship with risk appetite, relationship with commodity flows, etc. For example, if we think about the dollar Swiss and the dollar yen, these are two pairs that were traditionally strongly positively correlated, as both the Swiss franc and the Japanese yen are seen as safe haven currencies, meaning that in times of uncertainty, these are seen as low risk currencies to hold, and so they see big inflows. However, with the S&B removal of its currency peg and trouble with the Swiss banking sector, the Swiss franc is no longer seen as much of a safe haven, and so dollar Swiss and dollar yen are no longer strongly positively correlated. And if we just flick out to the dashboard, we'll be able to highlight the change in this relationship. So dollar yen across the top, go down to dollar Swiss here. So we can see at the moment that they're only displaying a 32.9% correlation, which is a very weak correlation indeed. Again, if we go out to the monthly, for example, indeed even the weekly, just bear with me while this loads. Okay, so we can see here how that strongly positively correlated relationship has deteriorated over time as that joint safe haven status has changed, with the Japanese yen still retaining its safe haven status, but the Swiss franc no longer holding the safe haven status that it once used to. So it's really important to keep an appreciation and understanding of the way these correlations are formed and also the way that they change. However, as these correlations do change so much, it's more important simply to keep abreast of the correlations dashboard to ensure that the correlations you're basing your trading ideas on are still intact. So that's a really useful way to use the correlations, is to make sure that you don't get overexposed in your portfolio. And that brings us on to another fantastic use for correlations, and that is using them for hedging purposes. So if, for example, we're holding some pairs that are strongly positively correlated and we wish to reduce our exposure, we can look to trade pairs that hold a strong negative correlation with our trading pairs and thus act as an effective hedge. So for example, if we consider the euro dollar, euro yen and the dollar Swiss. Now if, for example, at this peak we were short the euro dollar and euro yen here, as these are both strongly positively correlated, we would look to hedge our trade by also putting on a short dollar Swiss trade, because we know that from the correlations, if we are wrong and euro dollar and euro yen actually go higher, well then the dollar Swiss will actually sell off and thus mitigate some of our losses taken on those trades. So that's a really great way to use the correlations. Now, as you can see, there are a variety of uses for these correlations, and it's an incredibly interesting subject, so it's definitely worth you exploring more. The key point is, remember to always be checking the correlations day to day, week to week, month to month, depending on your trading horizons, as they do change. And in terms of staying abreast of the fundamental factors affecting these changing correlations, make sure that you check out the morning Forex report each day, where we highlight the key fundamental drivers in the markets that are responsible for shaping and changing these correlations. So I hope that's been useful. Thanks a lot.